Welcome to Thoughts on the Market. I'm Graham Secker, head of Morgan Stanley's European and UK equity strategy team. Along with my colleagues, bringing you a variety of perspectives, I'll be talking about our latest thoughts on European equities and why we see further outperformance from the region over the second half of the year. It's Tuesday, June the 15th at 3 p.m. in London. Over our last couple of podcasts, we've been arguing that investors have been underappreciating the investment case for European equities, particularly in light of the improving macro backdrop as the region reopens and economic activity rebounds. In recent weeks, it is becoming apparent that more investors are beginning to positively reappraise their view on the region, and we are now seeing a healthy increase in equity flows, which are running at their best levels in 3 years. A particular encouragement are an increase in inflows from US-based investors who tend to provide a healthy marginal bid for European stocks, boosting both absolute performance and general liquidity considerations. With global investors structurally underweight Europe, there is ample scope for the recent run of inflows, which should be counted in weeks rather than months, to persist for considerably longer if the investment narrative remains attractive. In this context, it is important to highlight that today marks a significant historical moment for European capital markets, with the region issuing its first joint liability EU bonds as part of the EU Recovery Fund that was agreed last year, i.e. this vehicle is now effectively live, and these new bonds represent a large and permanent euro-denominated asset class. The proceeds from these bonds could start to flow into individual nations' coffers over the next 1 to 2 months, ultimately supporting the longer-term economic outlook over the next few years. Given the broader MS Macro team has recently taken a more subdued view on global risk assets recently, we consider our positive stance on Europe more in terms of relative outperformance just here, rather than substantial absolute upside. This stance is backed up by our own market timing indicator, which is currently giving us a tactical sell signal. Historically, such a sell signal is considerably more dangerous for equity markets in the late stages of an economic cycle rather than early in a new cycle as we are today. Hence, we are not turning negative on equities per se, but rather arguing for a period of consolidation over the summer. As some of the market's macro drivers pause for breath, our client conversations suggest that investor attention is turning increasingly micro, with a renewed focus on stock picking. In this vein, we have recently updated our buyers and sellers compendium reports, where we run some of our quantitative screens across the European market to help identify potential new single stock investment ideas. Although these products are by their very nature more micro than macro, they can also provide a top-down perspective from time to time. On this occasion, they reinforce our recent decision to downgrade cyclicals, with the proportion of cyclical stocks screening attractive on our buyer's compendium framework at an all-time low versus the proportion of defensive stocks at a record high. For the first time in over a year, we no longer prefer cyclicals to defensives, having recently downgraded capital goods and semis and upgraded pharmaceuticals and food, beverage and tobacco. Thanks for listening. If you enjoy the show, please leave us a review on Apple Podcasts and share thoughts on the market with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or a solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.